I don't want to empower the government at the expense of the private sector. What I want is these new supply-side policies under President Trump to unleash the private sector. I've always said economic growth and low unemployment are not inherently inflationary. And now I want the Fed to just fade away. I want the Fed to become irrelevant under Trump. I want the policies that liberate the private sector to dominate. And I believe the increased supply, rather than the Fed's approach of trying to choke demand, will bring down inflation.
This is Little by Little with Andy Schectman. All right, everybody, welcome back to another episode of Little by Little. I could not be more honored and more thrilled to have on with us a hero to all of us in the gold industry. And I say that sincerely. The first person who's actually spoke our language to a degree, at least that I can remember, Dr. Judy Shelton. Dr. Shelton, thank you so much for coming on. It's a true honor.
Well, it's my great pleasure, my honor, and please call me Judy. And I like your little dog in the background.
Yeah, there's three of them. We have a new puppy, a new addition, and so I will apologize in advance if there's a little bit of chaos behind me. They have the run of the house and they're getting to know each other. So
no, I love it. I envy you.
Yeah, it's nice. The little puppy certainly brings a little bit of energy into the house. That's for sure. In any case, Dr. Shelton, I'll jump right into it. But again, we're just thrilled to have you here and looking forward to the conversation. So listen, let's start right away about your career. It's been deeply rooted in advocating for sound money principles. That's very obvious by the title of your book, Good as Gold. You often highlight the importance of stable currencies and referencing the gold standard as a model. Was there someone or something in your early experiences that particularly shaped your views on the role of gold in the global financial system? Because quite frankly, there haven't been too many folks who have advocated for gold quite the way that you have. So just be curious to know, what was it along the way that got you intrigued or interested or realizing the significance of gold in the system?
You know, it really wasn't some epiphany. It was really the result of being persuaded intellectually, with maybe a touch of morality thrown in there. But in my postdoctoral experience, I really found myself attracted to theories about how do you have the best form of money. And my book from 1994 was called Money Meltdown, but it really looked at theory and reality for different approaches to money. My office at the Hoover Institution, postdoctoral, was just minutes away from Milton Friedman's, just down the hall. And of course, I really thought Milton Friedman was great on domestic economic issues and personal economic freedom and a limited role for government, and even on some of his monetary policy ideas from a domestic point of view. But when it came to international, I was much more persuaded by the theory of Robert Mundell. And I was very fortunate to get to know both men, particularly Robert Mundell. In the end, in the last few years of his life, he let me co-chair with him his annual international monetary meeting held at his castle in Siena, Italy. And it was just a great experience. But I would say that I came around to believing that having an honest and reliable measure was more important than just letting money be another economic policy instrument of government to be manipulated to achieve governmental goals. But I thought it was more important and more consistent with our Constitution to serve personal goals and aspirations. And I think you need a reliable measure of value in a free market economy to be able to plan ahead, to decide whether you should produce or consume or invest, or should you be the guy seeking seed money for your ideas to generate higher returns in the future. If you don't have an accurate way to measure what the likely returns might be without all these complications of everything being inflation adjusted, I just think that needlessly distorts these types of decisions. So from a pragmatic point of view then, and then because it involves government, because government has long tended to get itself involved in money, then I brought in the moral idea that there's an implicit moral contract between the government and its citizens, and I think it's incumbent on government to provide sound money, which, if it's fiat money, requires sound finances. But I guess to answer your question, I really looked at different approaches. When I was getting my PhD, Friedrich Hayek introduced his paper on competitive currencies. So that was in the late 70s. That was intriguing to privatize money, to have monies that would compete with national currencies, but issued by private issuers, with the idea that competition gives you the best product. So why wouldn't you have competition in currencies? So it's not just the fixed versus floating. It's also the idea of private currencies, competitive currencies. Rothbard, I really like his approaches, which rely on a gold anchor. I really like Ludwig von Mises. So I would say I was more drawn to the Austrian school because that also imposes a limited role for government. But those are all the factors that influenced my attraction. And gold is so logical. It's so universal. It's universally recognized and historically acknowledged as a form of money. I've gotten to know Alan Greenspan extremely well. He liked my Soviet book and sent me a note back in 1990. And ever since, I enjoyed a good collegial relationship with Alan Greenspan and with Paul Volcker. So I feel like these giants who are not only in the arena, but also from academia, can all talk so logically. They're so conversant in describing the role of gold in monetary frameworks, historically and currently. Greenspan has said that gold is the only real money. And a former head of the IMF, a friend of mine in France, Jacques de la Rosière, in the last couple of months told me it's the only real money. So the people I really respect, most of them in their 90s or sadly have passed on, but who have been in the role of major central bankers or major economic thinkers and won Nobel Prizes for their work on historical monetary systems, they have no problem talking about gold. So I developed a pretty thick skin to people who might quickly write off a nominee for the Fed because she referred to gold as having many great virtues insofar as providing a reliable, stable money.
Well, I mean, the laundering list of folks that you had the privilege of meeting is enviable for sure. I would have loved to sat at a table with you and all of those people, just to learn, to be a fly on the wall, just to listen and to learn. It seems like Mr. Hayek might have been a champion for cryptocurrencies these days, a privatized money, if you will. And I think there are some people like Kristalina Georgieva, the head of the IMF currently, who quietly says that a central bank digital currency not pegged to something would be fiat, with the BIS reclassifying gold as tier one. And the report that came out of the IMF at the beginning of 2023 saying gold as a international reserve currency, a barbarous relic no more, kind of alludes to that. But I wasn't going to ask you this question, but I mean, it just would seem that you would be the exception in the halls of the Federal Reserve, someone who favors Austrian economics and gold. Is that pretty much true? I mean, are you kind of a lone wolf, so to speak, in this space, or are more people quietly on the side of Austrian economics, on the side of limited government, and on the side of sound money, just don't have the courage, perhaps, that you do to say it?
It's I see why you would wonder about that. when you consider that Greenspan was in until 2006, and then after that, I remember about a year after he left, he was interviewed on Fox Business by David Asman, who said, "Why do we need a central bank?" So here's this preeminent central banker who had been called the maestro. He said, "You ask a very interesting question." And he went through talking about fiat money, and that's what we have now. But he said, unless you have a gold standard or a currency board or some kind of a way to limit the issuance of money, we have found, history has shown, that you will have inflation with very deleterious effects. And he ended up that statement by saying, there are some of us, myself included, who still think we did very well under the classical international gold standard. So I would say as recently, and we still have Greenspan with us, out of the limelight, but there was that legitimacy, let's say, even if, and he told me this the day I was about to publish Money Meltdown. I was quoting some of his comments on gold, and he was sensitive to it. We talked about it in his office at the Federal Reserve. He said, "I can't be a free spirit." I said, "What do you mean?" And he said, "If I mention gold, or I'm quoted as saying that that's a good anchor," he said, "it causes reverberations." And he pointed to this array of terminals, away from his sitting area. He said, "I can go into a closet and say what I think." And I said, but he said, and then he made it clear. He goes, "It's not that I don't still hold those views." I said, "Well, then you must say it." But we agreed that what I would do is put forward the quotes that were already in the public realm. Now, he held the copyright to his essay, Gold and Economic Freedom. That was in Ayn Rand's book, Capitalism, the Unknown Ideal. That was 1966. But I said, I'm going to paraphrase some things we've said, and I'll put it in a footnote. But things you've said in the public realm, I can legally quote. And then he said, well, bring me a copy of your book. And when it comes out, he literally said this, but put it in a brown paper wrapper. Because if I'm walking up and down these halls at the Fed, it might not be good for business. So, but the bottom line is, Paul Volcker likewise. Sometimes he would come to this meeting that Mundell had every year. We often sat together, and he would nudge me and say, "Why don't you pipe up about gold here?" I mean, they were very comfortable talking about that. And Mundell would go back and look at the original Articles of Agreement for the International Monetary Fund and setting up the Bretton Woods Agreement. And so does that still exist? As I say, my friend Jacques de la Rosière is in his 90s. He has the #1 book on money and monetary policy right now in France. And it's on whether France can recover from its decline. And he is the one who has long supported me and said, how can you have free trade if you don't have a level international monetary playing field? And he has said that gold provided that anchor, and he goes back to the original purpose of Bretton Woods, which was to have fixed rates. Now, Milton Friedman hated the Bretton Woods system because he did not trust governments to honor their agreement, and he proved to be right. But Milton Friedman also said that a gold standard is completely consistent with authentically free trade. People sometimes leave that out.
Yeah, I think first of all, your memory is fantastic, and I think people in this industry would certainly vote for you to be running the Federal Reserve. We don't hear these things enough. We don't hear about sound money, free money, the virtues of precious metals, the virtues of limited government, and it's delightful to hear it coming from you, and I admire tremendously. Before we get back to talking about gold, I always promised myself that if I ever had the good fortune of sitting down with someone like yourself, I had to get this one burning question off my back. And that was that, I understand the Federal Reserve has a dual mandate. And one of those mandates is to control inflation, to inhibit the awful word of deflation. I understand that. But I guess the question that I have that I know many people have is, who decided that 2% inflation was the number? And would seem to me that preservation of savings and stable prices would outweigh the potential risk of deflation. But how did it come to 2%? And you agree with that?
Great question, and I vehemently disagree with it, because you referenced, as you were asking this fantastic question, you said the Fed's dual mandate is to control inflation. No, it isn't. The Fed's mandate is actually three-part, but it said that they should promote stable prices, not stable inflation. Stable prices. The promoting maximum employment, the original legislation actually called on the Fed to have a 0% inflation rate 3 years hence, like 1980. So we're talking about 1977 legislation, the Humphrey-Hawkins Act, it was called. And it also called for a 3% unemployment rate. But the 2% target, the most fascinating thing, and so I really recommend it. It's great reading. If you can dig up the transcripts from the Federal Reserve Federal Open Market Committee meeting of July 1996. And Greenspan was chair. Janet Yellen was a governor. Jerry Jordan, now there's another one, an intellectual. He was from the Cleveland District Fed, so he was a regional bank president of the Federal Reserve System, but definitely an intellectual on our side. And the question of the day being discussed around the big mahogany table at Fed headquarters in D.C. was, and Greenspan asked it, what does our mandate mean, stable prices? Does that mean zero inflation? Greenspan was inclined to say, yes, I believe that's, what else could it mean? Janet Yellen was called on. She gave a strong argument based on the theories of her husband, George Akerlof, a Nobel laureate. I referenced him in my own dissertation. I'm not saying he's a worthless economist, but one of his theories that she alluded to, very Keynesian, said, you have a problem with human psychology. And economics is a social science, so you don't just dismiss this. And the problem is that people really hate to get a cut in their wages, and firms really hate to do it. Therefore, you have to recognize there will be instances when there's economic decline generally, and it would become necessary and appropriate to cut salaries in accordance with falling revenues or just lackluster economic performance. But that would be so demoralizing for workers, they might just quit. Therefore, if you have inflation, let's say 2% inflation, you could give someone a 1% nominal increase in their wages, and they would feel good. They got a raise, but you're actually cutting them. And she made a not to me, but to others, this is called greasing the wheels, Keynesian argument that this would be better. People would be more comfortable working. They wouldn't get up and quit and look for something else. So you would have more stability. But it's based on money illusion and the idea that people won't realize they're being cheated or that they're suffering. I won't say cheated. Well, it is, because it's deceptive. But they're saying they'll take that better. And again, she kept hitting the psychology part of it. They'll take that better than out and out saying, I'm sorry, we all have to take a 1% cut until business improves. And to shore up her argument, she said, and a survey was taken of workers, a survey, and it said, would you feel good about an increase in your salary, even if, the way they put it, even if inflation was equal to that amount? And a little over half of the workers said, yeah. Now, I don't blame them, because usually workers are the last to be brought up even with the impact of inflation. So I'm thinking even a rational worker would say, yeah, I'll take it. At least I'm even. But she said they would be fine with it. She said, but you'll all be happy to know, looking around that big table again, we asked a group of economists if they would be happy to get an increase in their wages that was only equal to inflation. And you'll be glad to know they said no. And the transcript shows laughter around the table, which I found offensive. The idea being, we economists are smart. We know we really hadn't gained. But those ignorant workers would be no wiser, and they don't understand that a nominal increase isn't real, especially if inflation outranks it. Well, that is proven false. Just look at the union negotiations. A long time ago, workers got very wise to that and now demand even extra compensation because they imagine they're going to be cheated by the money itself. And it was Jerry Jordan, that same Cleveland Federal Reserve Bank president. He said the most beautiful thing when it was his turn, when Greenspan called on him. He said, I would recommend a different survey. He said, we're talking about whether it should be 2% inflation or 3% inflation now, based on what Janet Yellen said. He goes, I think if you were to say to workers, would you rather have a dollar be worth 5 cents 100 years from now or 13 cents? Because that was the difference between 2% compounded or 3% annual inflation, the deterioration in the value of the dollar. He said, I think most people would say, why should there be any? Why should it not be worth $1 100 years from now? And then he went on to say, I think the best thing you can do for workers and for an economy is to have meaningful price signals. And you convey that through a dollar that serves as a unit of account and a store of value that is reliable. And he could not be dissuaded from that position. Now, the 2% target, by the next day at the Fed meeting, they all decided not to talk about this. And remember, the transcripts used to not come out for a long time. They said, I think if we made it clear that we think 2% is the meaning of stable prices, there might be people in Congress who don't accept that, because the Constitution just says it defines Congress's role in regulating money in the same sentence that it gives Congress the power to define official weights and measures, because the money was meant to be an unvarying standard, an official measure. So they were afraid if they were very vocal about this interpretation, Congress might not like it. And so they really went kind of silent on that. And it wasn't until under Bernanke that they officially described the Fed's framework would be that it was not only a 2% inflation target, that's their definition of stable prices, that lose the dollar losing, deliberately being devalued 2%. So think after 10 years, 20% devaluation. 10 years is not so long. And that they would define it in terms of the personal consumption core index. So that's a long answer to your very good question. Why 2%? I definitely think it should be 0. If I believe the Fed could target that through what? Higher interest rates? No, the whole model. What I would like, it should be thrown out. What I would like to see now, I'm okay. Now I'm switching to today, if I may. I'll take that rate cut yesterday on behalf of the small and medium-sized businesses that have been paying the price of the fiscal recklessness of the Biden administration and Congress. Because when the Fed uses high rates, restrictive rates, to curtail economic activity, whose economic activity are they curtailing? Small business, the private sector, not the federal government's. The federal government isn't phased. They're immune to the cost of capital. Deficit spending, they'll raise the money through treasury markets by auction, whatever it takes. We see these high rates on treasury securities. So they just tack it on to the next estimate of future deficit spending. The only ones it hurts, the Fed's policies, when you have fiscal overspending and putting money in people's pockets and injecting it through government projects into the economy, you'll get inflation no matter what the Fed does. So why I don't want to empower the government at the expense of the private sector. What I want is these new supply side policies under President Trump to unleash the private sector, those small and medium-sized businesses. Corporates have been okay. They've been able to borrow. But it's the smaller ones who go to their commercial bank and get jilted. Well, now if they have a chance to expand plant and equipment, hire people, I've always said economic growth and low unemployment are not inherently inflationary. Let's let that ride. I'm very comfortable at 4.25 to 4.5 right now as the rate. And now I want the Fed to just fade away. I want the Fed to become irrelevant under Trump. I want the policies that liberate the private sector to dominate. And I believe the increased supply, rather than the Fed's approach of trying to choke demand, will bring down inflation. I think that's why it has come down. Certainly not because of what the Fed's done, because the Fed's, their model was you'd have low growth and high unemployment. We didn't get that. The reason it came down was increased supply. And when inflation comes down, then I want that rate not to be 4.25 to 4.5, which I think is showing about a 2.25 would be a real interest rate. You don't want zero ever as the interest rate. You want a real return on lending capital. I'm comfortable with 2.25, but as inflation, let's say inflation did go down, what crashed through the 2% target and got to zero, then that rate should be 2.25. The real rate with no inflation. My fear is the Fed's model is to say, well, if we start to go below 2% inflation, we have to start quantitative easing. We have to start buying government debt again. And that was the big mistake. That's what the Fed shouldn't be doing. And I think we are inordinately afraid of deflation. Deflation is actually the natural progression of technology and innovation. And if you have crippling deflation, your problem isn't monetary policy. Your problem is, like in China, government management, inefficient management of economic resources. So then deflation is just a symptom of that, as everything starts to shut down and not work because of all the distortions. Mild deflation, to me, is the natural rate. I mean, if the Fed's target was zero, I would still consider that mildly stimulative.
Yeah, I couldn't agree more. It would just seem intellectually that the lower the level of inflation, the higher the standard of living. So that would just be from a mile high. And I find it interesting. You call it greasing the skids. It's very greasy. I remember my dad saying to me, he graduated college in 1963, and he was thrilled to have a job that paid $6,500 a year, and he lived comfortably. You can only imagine what that would be today, and how the value of money has been eroded through the incessant levels of inflation. And I just had to get that question off my chest because it never did make sense to me. And thank you for your candor. It's fascinating to hear your perspective on that, and couldn't agree with you more. Shifting gears then, Judy, back to gold. In your latest book, Good as Gold, which is an amazing book, I would highly encourage people to read it. You propose reconnecting the dollar to gold through federal treasury bonds with gold redeemability clauses. I guess you could call this, and you can correct me if I'm wrong, kind of a quasi-gold standard. It's not the traditional gold standard that we saw prior to 1933, but nonetheless, it gives legitimacy to the dollar and to the treasury bond. And can you explain how this approach would work if enacted, and what impact you think it would have on our global financial system and the monetary policy of the United States?
With pleasure. Thank you for the question, and thank you for mentioning the book. Any royalties on the book will go to Independent Institute. So I'm grateful that people buy the book or like the book. Well, the Independent Institute is a great organization, and they encouraged me to write the book. So I just want to, and they're terrific. When I have found myself talking about the importance of sound money, and of course, then written off, oh, gold bug and all that, which, as I say, to me, the intellectual giants would take the opposite approach, but a columnist at the Post or Washington Post or New York Times, I think it shows a certain amount of ignorance about monetary history, but that's their problem. What I thought I would have to do, though, is have an actionable plan. You know, you can't just say, oh, I believe in the gold standard. We have, I think, 2.5 trillion outstanding in Federal Reserve notes. That's just paper U.S. money. And about 70% of it floats outside the United States. And you would see giant billfolds, and I have, in Moscow and other places where they carry around $100 bills from the United States. We don't want to say, oh, we're going to use our gold to redeem that for you. So, I mean, we don't have enough, for one thing. At current market prices, we do have a considerable amount, 261 million ounces. So let's say at roughly, I was using 2,700, maybe it's 2,600 now, in between, but say about 700 billion worth. So I am not suggesting anything. I find myself saying, if someone says, oh, you're for a gold standard, I'm like, do you know what you mean by that? Or what do you think I mean by that? Because you, of course, are well-versed, and you could be talking about the gold standard, the classical international gold standard from 1880 to 1913. You could be talking about the Bretton Woods system, which was about 1944 through 71. I'm not talking about either of those. What I'm saying is something that I think is doable that would start to put the spotlight on what it means to have sound money, to look at the virtues of those former systems, which, for one thing, say the classical international gold standard was an organic system, self-disciplining. You don't even need a central bank to have a gold standard. If you define the dollar as a certain weight of gold, which Thomas Jefferson did with the Currency Act, and you define it with precision in terms of a specific weight of gold and silver, it doesn't mean the government is standing ready to give you gold or dollars in exchange for that. It means this is what a dollar is. That's what all countries did under a gold standard. And if you're an agent in the economy, meaning any one of us who's in the real economy, and you sense things are getting frothy, you think too much credit is being created for less than valid investment projects, you can redeem. That is, there's a standing level of convertibility that a dollar is worth this amount of gold, so you can exchange with other people. I mean, that's it. And that was available to individuals. So at the margin, when you would trade in paper for gold, you could go to your bank and do it, for example, that automatically contracted the money supply, because credit is based as a multiplier on the base money. So gold is the base money. So when you trade in something that otherwise could be multiplied, because you can sell your credit, they sell it, your note, your IOU. But if that contracts, you have contracted the money supply. So I like that approach, instead of 12 people who vote 8 times a year to decide what is the appropriate cost of capital at a free market economy. I trust the aggregate wisdom of participants in the economy more than technocrats around a table. The other main virtue with regard to international trade, that was the whole point of Bretton Woods was to say to countries who were still fighting World War II, because these plans were set at the Treasury and State Department 10 days after Pearl Harbor was bombed. They started writing the first drafts. And it wasn't until July of 44, so it took from December 41 to 44 to say the United States is going to tell these countries, because we don't want them to lose heart, the ones that are still fighting Nazis. Morgenthau, our Treasury Secretary, made it clear we want to give them hope for a better economic future. We want them to know we're not going back to the 30s. The 30s were the era of beggar thy neighbor, currency devaluations, where our trade partners would depreciate their currencies to gain an unfair trade advantage against us. And the way you compensate for that unfair trade advantage that hurts your own domestic producers is to apply a tariff. So then you get into that tit for tat. They depreciate, you do a tariff. They depreciate more, you do a bigger tariff. And that definitely hurt international trade. It hurt individual economies and the entire world economy. And some people think that set the stage for the economic tensions and disquiet at the end of the 30s, and certainly in Germany. So under Bretton Woods, you had fixed exchange rates. The countries who were participants in the Bretton Woods system, the Accord of 1944, had to keep their currencies within 1% of a fixed exchange rate with the dollar, and the U.S. dollar was convertible into gold at a pre-established rate, $35 per ounce of gold. But instead of individuals being able to exercise that convertibility privilege, only foreign central banks could. And they did so somewhat reluctantly, but they did so. So that was that system. It wasn't until we had that fixed exchange rate, level international monetary playing field, that the U.S. became a champion of free trade. Because you can't have free trade if you're letting people cheat. I don't know why people talk about free trade without acknowledging the impact of currency manipulation, or even call it no fault, but currency depreciation. The point is it gives them an unfair price advantage against domestically produced goods. And the U.S. has depreciated less against gold. I just looked at the numbers yesterday. In the last 10 years, than all of our 5 major trade partners. We've all depreciated our currencies. But Mexico, for instance, twice as much as we have. Those are 2 different uses of gold to provide 2 very important things. An organic, inherently disciplined approach to managing the supply of money and credit, calibrating that to the needs of the real economy, and to have a level playing field for international trade. What I'm suggesting, which will be called radical and dangerous, is one specific, doable initiative. We have those 261 million ounces that are worth about $700 billion. We are carrying them on the books at the Fed and Treasury at a book value of $11 billion. So there's a huge windfall profit in there. Those are the family jewels. We are in a family emergency from a fiscal sustainability point of view. I think it would fit in beautifully with what President Trump is introducing in terms of a renaissance of American economic recovery based on entrepreneurial energy. And I love that he refers to a golden age for America. I think on July 4th, 2026, which he plans to celebrate big time as the 250th anniversary of our nation's founding, U.S. Treasury, for the first time in over 50 years, should establish a link between the U.S. dollar and gold by issuing 50-year Treasury bonds. It's something discussed when I was on transition for the first Trump administration at Treasury. They looked at 50-year. France has a 50-year. But they decided 30 is, investors are fine with 30-year. Do a 50-year bond, and at maturity, it'll have a face value of the dollar. At maturity, bondholders can take either the dollars or the gold. fixed rate of convertibility preset so they know they can have gold. And I think that would send such a signal that we are truly moving toward sound finances. We see that with Doge. Fantastic. Let's do it on the monetary side. Let's have a dollar that is literally as good as gold. And let's let that dollar compete. Let's let those bonds compete alongside treasury bonds that are backed by the chair of the Fed saying we're really committed to our 2% target, which as of yesterday, they now think they'll hit not in 2026, but by the end of 2027. So you tell me what kind of a commitment that is versus a dollar that you know today, what you can have the option to convert your treasury loan, you're lending to the U.S. government, but just like a TIPS bond, it's really very similar to a treasury inflation-protected security, which is very popular and which Fed officials use to judge aggregate expectations about future inflation. A TIPS bond compensates people who would buy treasury bonds, they're willing to invest in the U.S. government or finance its debt, but they expect to not lose purchasing power. And so they get compensated in accordance with the CPI. Well, what this is saying is someone says, I'm willing to lend money to the U.S. government, but I want to ensure I'm not going to lose purchasing power, but I define it in terms of real commodities, and my surrogate for that is gold. So in some ways, it's like existing treasury instruments. It's a new option for bondholders. It wouldn't be the smallest type of treasury debt that we issue. We have floating rate notes from 2014 that would be worth about $600 billion. This would be worth more than that. This, if you use the whole 261 million ounces, we're talking closer than to 700. If gold goes up, it's more. But that is my idea. And the other benefit of that is I don't want some future Congress or president to say, hey, let's just sell that gold. Let's just sell it. They did that in England under Gordon Brown when gold
at the
was
bottom at 252 bucks an ounce. Yeah.
I was in a cab in London and the driver told me how stupid the prime minister was to have done that. So people, that would be a
history has
mistake.
shown that to be the truth. Yes.
It would have been, it would be such a mistake. So let's warehouse that gold, audit it. I can't believe how many people have written to me, I love the idea, but I don't trust that we even have it. I think they've already used it up somehow. Audit, warehouse, and assign it as specific collateral for that bond. And then that's sending a message that on July 4th, 2076, we're still going to be here, standing tall, the United States, and we will be honoring, look, what would be the greatest thing? What if people rather have the dollar than the gold? What if they choose that option? But until we get our house in order, that seems laughable. So let's give them that guarantee.
Yeah, I think and this is why I called you the hero to all of us in the gold industry. I've been doing this for 35 years, and I've never heard anyone speak as commonsensical, I know that may not be a word, as you. And it truly is something that warms my heart. And to the trusting the CPI versus gold, there are a lot of people who don't believe the CPI, and you stole one of my questions. The next question I was going to ask you about auditing the Fed. It's an issue of trust. And I guess you could go back to Charles de Gaulle, who didn't trust the way that we were doing things and said, give me the gold. And in a system right now that is lacking trust, it boggles the mind why the gold held by the United States people or by the Fed on behalf of the Treasury, the people's gold, hasn't been audited in 70 plus years. And they cite logistical, political, and security concerns as the reasons. That makes no sense to me. The most powerful government on the planet doesn't have to worry about logistics or security or any political concerns unless the gold isn't there. Wouldn't the comprehensive audit enhance transparency, reinforce public trust? And in essence, that's what you are saying. You're saying that that the 50-year treasury that would be collared to gold would enhance trust, would speak to a commitment of
Yeah.
authenticity and of sincerity. Judy, why haven't they audited the gold? Why was Ron Paul turned down? What is, in your mind, the legitimate reason? And don't you think, you kind of alluded to, that it is necessary, at least before we get on to issuing treasuries backed by gold? Do we not need to prove that the gold is truly there?
We do need to. This is all about reestablishing trust. And in fact, in the book, I suggest we call these Treasury Trust Bonds, TTBs. If you call them Trump Treasury Bonds, that's okay with me too, if he's the one who initiates this. But yes, it's about trust. Now, on the audit, I'm not familiar with what has or has not been done. I'm a great admirer of Ron Paul, a man ahead of his time in many of these questions. But I certainly share his skepticism of government pronouncements, and certainly of the Fed's omniscience in deciding how to calibrate the proper level of money and credit for our free market economy. We're really talking about two different things, I believe. It would be Treasury. Treasury actually owns the gold, so that means it belongs to the people. It's really our patrimony in that sense. So Treasury would have to conduct the audit, and I presume we're talking about Fort Knox and the New York Fed basement and other places, a marginal amount at the Mint. But spend $1 million, have a first-rate private audit company conduct that. I think it is necessary. You talk about something that is intriguing to me in a different sense, auditing the Fed. Now, the Fed they are audited, but they don't use generally agreed accounting principles. They aren't subject to the normal way that accountants would judge their operations. I would love to audit the Fed. The Fed resists outside inspector generals and audits because they say, oh, well, that violates our independence on monetary policy. I'm happy to criticize their monetary policy decisions, but I'm talking about, I put on my green eye shade. I love accounting. That's when I did my book on the Soviet Union. I was an accountant. I was looking at the books and figuring out what the plug figures were. What I resent, and I think we need to, again, shine a spotlight here, the Fed, when they engaged in quantitative easing post-2008, of course, they bought trillions of government debt and mortgage-backed securities. And that generated a lot of income on the Fed's portfolio. And in those days, interest rates were near zero. So that money, they were required to remit back to Treasury. So for about 10 years, the Fed was sending back, over those 10 years, over $1 trillion, they gave it back to Treasury, and that turned out to be the 6th or 7th largest source of income. The Treasury, our budget numbers showed that as revenue to the budget. That's how we counted it. And so that became part of all of the budgeting process. But now that the Fed, when they started raising interest rates, is paying, even now, 4.25%, on $3.3 trillion in cash reserves that are kept by banks in their master accounts at the Fed, doing nothing, sitting cash in those accounts. The Fed is paying the banks not to make loans to the private sector, keep it there. They entice them with the high rate, but they're calling it restrictive. So it's only restrictive in that small businesses don't get it because the banks say, we can do this all day long. We'll just collect that amount. So now the Fed, for the last couple of years, has been running a loss, an operational loss. They don't even make enough off their own portfolio to pay what they're paying out in interest returns to the banks. So right now they're losing about $140 billion a year, and it was higher than that before. But do we now count that as a budget expense? No, we always counted when they were making money between their portfolio and what they paid banks. They counted that as revenue to the budget, but they don't count this as an expenditure of the budget. This ridiculous accounting approach they've taken is they call it a deferred asset. And they're accumulating hundreds of billions in losses and saying, because we won't be able to start remitting money back to Treasury until we make up for that difference. But instead of showing that someone's paying it, that's real money. That's real money being paid to banks that goes into their income statements and pays their employees and dividend recipients. That's real money. That income, where is it coming from? And it's just a black hole, because the Fed then says, we don't want anyone to oversee our operations because we're independent. But if you look at the Fed website, one of the basis, the tenets for their being independent that they state clearly is because we never have to go to Congress for a budget appropriation. Because this is the first time in their history that they haven't been able to cover their expenses, and for a long time by tenfold. Well, now they can't cover them at all. But this loss, which is requiring them to pay out real money, is not coming from Congress. So who appropriated that money? These issues Americans deserve to understand, because I think the practice of paying banks not to make loans is perverse. It's anti-free enterprise. And I do not like a government agency to be paying that money, which I think is harmful. They could be selling off their portfolio. They could control interest rates that way, but they prefer to do it through these administered rates because they control them, just like the old Soviet ghost bank. And I would like to highlight this practice because I think Congress would disapprove.
Yeah, it's silly. It's very silly. You know, people probably don't realize that when the Fed buys the bonds from the banks, they have two options. They can either lend it out into the system or park it at the Fed, earning that interest. It just seems silly. You would think they would just slash that interest rate to disincentivize the banks from doing that and to make it more productive. A very interesting perspective nonetheless. I have two questions left for you. And you know, it's hard. I've watched some of your videos. It's hard for you, I think, for anyone interviewing you to do a short interview. You're fascinating and such a massive vault of information. I really appreciate your time, and I'll try to do these last two quickly. You know, you've mentioned at current levels a couple times. The head of the Dutch National Bank has talked about revaluing the price of gold, and ironically, it's held in an account called the Gold Revaluation Account. $35 an ounce throughout Europe, $40 to $22 here in the United States. Cynthia Loomis, the senator from Wyoming, who spoke at the Bitcoin meeting right after President Trump, saying, you know, we should revalue the gold that the Federal Reserve holds on behalf of the Treasury. We should revalue it to a level sufficient enough to help fund the strategic Bitcoin account. We keep hearing this term gold revaluation. In order to, at least in terms of your idea of putting a collar around a 50-year Treasury redeemable in gold, does gold need to be revalued? And is that something, when you realize, I guess, the BIS reclassified it Tier 1 and the central banks have been buying it voraciously for the last several years, not only does it would presumably benefit all of the central banks, but at the same time, is it something possible, and would it benefit your thesis?
And I will give you a short answer, I see. But I have enjoyed our conversation, so forgive my being so long-winded.
That's okay. No, I love it. I got all the time in the world.
Well, I don't, fortunately, but thank you. Sorry, I just noticed the time. I have enormous respect for Senator Loomis, and I love the crypto community. I love the competition to the dollar, and I think at some point we're going to have to examine legal tender rules. There's one thing, you can have competitive currencies if you just define the dollar as something in tangible terms. I mean, that was the beauty of the gold standard. And then you could have competitive currencies, including cryptocurrencies. I like the benefits to the consumer, block technology and distributed ledger. Definitely, we want to capture that. But I would say this, Bitcoin doesn't need help with the strategic reserve. That's my position. I mean, Bitcoin doesn't need help. They're doing just fine. Gold is already an asset that the U.S. government, that the Fed is allowed to show as an asset, and that the government holds as an asset. It doesn't hold silver, doesn't hold diamonds. It does have gold. So that's a residual asset from the prior monetary system. I think that it would not be appropriate to, when you say revalue the gold, we're talking basically of marking to market. And you're just, instead of carrying it at $42.22, as you very correctly said, you would bring it up to today's market price. And that's where you get the windfall profit. Or she's talking about maybe use that to fund, and they're being very gingerly in talking about it. I'm saying openly, no, save it, use it all for the gold-backed bond. People understand that. Not everyone's into crypto, but the people who are pretty savvy, and they're doing just fine. I would rather help the crypto community in terms of taxation laws and having that be a level playing field with legal tender and allowing people to use it without being penalized as from a tax point of view, not treating crypto as a commodity, maybe give it some kind of monetary status. But no, let's keep the gold as the most basic thing. And have a gold-backed bond. Now, you could use crypto to enhance that. You could have stable coins that were backed by Treasury trust bonds. And then that would be a way to sort of bring together the power of digital currencies with this idea of a dollar as good as gold. So I would really like to see that and see how that would compete against stable coins backed by Treasury holdings or even straight out dollar reserves. I think that could be interesting, but I'm for using the gold to back a gold-backed bond.
And I agree. I guess the only other point would be, do you see a drive to revalue it to back the bond? Is that something you would advocate for?
I would say if I can make my elevator speech to the president and he likes it, then it could be done. A gold-backed bond could be accomplished by his Treasury Secretary, Scott Bessent. Just as Treasury inflation-protected securities were brought into being under Robert Rubin during the Clinton administration. It's just a Treasury offering. But with the president's blessing and through the efforts of his Treasury Secretary, you could introduce it. And I'm saying that in doing so, you capture that windfall profit because you're essentially selling this issue and it's collateralized by that amount. And I think, talk about good accounting, that's where we'll work it out. And depending on what we want the maturity dates, whether you have interim maturity dates, shorter, whether you make it a savings bond that grandparents buy for their grandkids, or you make it something that investors can buy, or you have private money market funds that are hedge funds set up. They replicate the combination of, say, a gold future with a traditional Treasury security to essentially give the same return profile.
It's genius, Dr. Shelton, as are you. And you might have good luck on that. The Treasury Secretary-elect Bessent has recently said that gold is his largest holding, so you never know. Right. This has been beyond an honor and a joy and a lesson in economics and in logic. How can more people find out more about you other than this book, which I strongly recommend everyone read? What's the best way to follow your work? And I will be following you and championing everything that you do as a hero to this industry, to sound money, and as a patriot to the United States of America. God bless you. What is the best way for people to follow you?
Well, I'm humbled by your gracious comments. Thank you. That's extremely kind. And I will savor that. Thank you. I'm on Twitter at Judy Shell, at JUDYSHEL. If you go to the Independent Institute, I'm sure they archive all of my work, and those are probably the best places. I'm pretty regularly. In the Wall Street Journal, I had a commentary, I don't know, 2 or 3 weeks ago. I was on Maria's Bartiromo this morning, and you'll see me, CNBC or Fox Business. I'm out there, but if people want to follow me, I certainly welcome them on X, and I regularly post comments.
Well, you know what? We'll link all of this at the bottom, and I hope to see a lot more of you. And I hope somehow you find your way onto the Federal Reserve Board and inject your amazing wisdom and logic and level-headedness back into monetary policy for the good of us all. Dr. Shelton, this has been the greatest interview I've ever done. Thank you so much for jumping on board. I would love to say we can do this again someday down the road, but who knows what your schedule has in store for you. But I will look forward to picking up where we left off. And I wish you and everyone else out there happy holidays and the best of prosperity and health and happiness in the coming year. But sincere thank you for coming on today.
My great pleasure and honor. Thank you.
Yes, ma'am. Thank you.
Little by Little with Andy Schectman.